Between January 15 and February 14, 2026, AI agents erased approximately $2 trillion in enterprise software market capitalization. Between January 15 and February 14, 2026, approximately $2 trillion in enterprise software market capitalization simply vanished. There was no recession, no regulatory earthquake, no black swan macro event, yet the iShares expanded TEFware software sector ETF plummeted from an all-time high of 1 in 17 to 82. Atlassian dropped 35%. Salesforce shed nearly 40% from its 2025 highs. The financial press quickly gave the event a name of the SaaSpocalypse. To understand why this happened, you have to understand the foundation of the software as a service, or SaaS, model. For 2 decades, the industry operated on a single, beautiful assumption: more employees meant more software licenses. This is the per-seat pricing model. If a company hired its first employee, it needed its first Salesforce seat. Revenue scaled with headcount. Headcount scaled with growth. It was a predictable, compounding engine of wealth. But in early 2026, that engine hit a structural wall. The catalyst was the arrival of AI agents. Unlike a chatbot or a copilot, which assists a human, an AI agent is autonomous software capable of executing multi-step business workflows end-to-end. On February 3, 2026, the market hit a breaking point. Anthropic unveiled Claude Cowork, a suite of agents capable of managing lead generation, legal auditing, and payroll workflows without human intervention. Simultaneously, OpenAI rolled out ChatGPT Agent Mode, an intelligence overlay that could navigate any software interface autonomously, effectively bypassing the need for a human to log into a dashboard. Traders at Jefferies called February 3rd Black Tuesday for software. The S&P 500 software index collapsed 13% in a single session. The panic wasn't about technology failing, it was about the technology working exactly as advertised. Investors finally did the math on the efficiency paradox. If 10 AI agents can do the work of 100 sales representatives, a company no longer needs 100 Salesforce seats, it needs 10. That is a 90% reduction in seat revenue for the exact same work output. This created a brutal reality. The better the AI worked, the less time humans spent inside the platform. Better product, less revenue. This is the efficiency penalty. The market realized that AI agents weren't just eating SaaS, they were rooting around it. The moat was gone. For the first time in history, software forward price to earnings multiples fell below the S&P 500 overall market multiple, dropping from a peak of 84 thanks to down to 2x by March 2026. The carnage continued through April. On April 9, another wave of selling hit. Cloudflare plunged 12%, Snowflake dropped 9%, and Palantir saw a 17% dip over 3 days. The market was separating the AI native from the AI vulnerable. Companies selling basic workflow tools, IT ticketing, CRM data entry, standardized HR processes were exposed because any agent could learn to operate them. Meanwhile, companies with proprietary data moats like Palantir remained strong. Palantir reported revenue growth of 70% in the fourth quarter of 2025 and projected 61% for 2026, positioning itself as an orchestrator of AI systems rather than a simple tool. But as the industry scrambled to survive, a new risk emerged: silent failure at scale. According to CNBC, AI agents don't crash loudly, they make small, confident errors, updating a record with slightly wrong data or approving a transaction that shouldn't clear. By the time a human notices, the damage has compounded. An EY survey found that 64% of companies with annual revenue over $1 billion had already lost more than $1 million to these AI failures. Even the developers were uncertain. Alfredo Hickman, CISO at Obsidian Security, noted that model developers admitted they didn't know where the technology would be in 1 to 3 years. To survive the SaaSpocalypse, the survivors are abandoning the seat. They are moving toward results as a service or outcome-based pricing. Adobe transitioned toward a generative credit system, where users pay for the specific asset produced, not the software used to produce it. Salesforce introduced Agentforce, charging roughly $2 per AI conversation. This creates a revenue air pocket, a short-term earnings dip while the new model matures. But it is the only path forward. By the end of 2026, Gartner projects that 40% of enterprise applications would include task-specific AI agents. The money isn't leaving tech, it's relocating. Hyperscalers like Google, Microsoft, and Amazon planned over $470 billion in AI infrastructure capex for 2026. The SaaSpocalypse wasn't the death of software, but the death of the human-operated interface. The software that survives will be the software that AI agents cannot function without, not the software that humans needed because they couldn't automate the task themselves.